Do you want to look for value, or do you want to step away and think, okay, the volatility isn't over just yet?
The volatility is not over just yet. We're looking at a very uncertain trade discussion that's going to happen later this month, and that's issue number one for the markets. We also have the disappointing economic numbers that are coming out on the manufacturing side. We're seeing a slowdown in the U.S. labor market. Europe's GDP numbers continue to decline and be weak. And then there's the global instability, whether it's in Hong Kong, a hard Brexit. So there's too many factors right now to back the truck up for stocks.
All right. Well, we got the September jobs report out tomorrow. So I want to ask everybody here, as well as you, Mark, when are we going to see this slowdown in economic growth or this pullback in CapEx hit jobs and managers' expectations in terms of hiring more people? ADP yesterday came out, showed that private sector hiring is slowing a bit, but it was still pretty close to the estimates. 135,000 jobs added to the economy in the month of September. Are you seeing a tighter and a slower labor market? What's your prediction for tomorrow's jobs report?
Well, I think the jobs number is going to be reasonable. It's going to be in the same range that we've been seeing, but we're not going to be looking at 250,000 month over month. I think it's going to be more around the 150 range, and that reflects where we are. The economy is steady. It's not falling through the floor. No one's predicting an immediate recession, certainly not my perspective. I think we're looking at a real muddled picture, a wait and see. There's too much uncertainty. Employers are not hiring. They're not investing. They're not putting in CapEx, and that's why you see an overhang in this number. It's going to be more a wait-and-see market.
So it seems to me the big story of this period of time is the negative interest rates all over Europe, trillions of dollars in negative interest rates. And I think that's weighing down Europe. I don't think it's helping growth there. And for a year now, we've looked at overseas economies basically weighing on the United States. What do you see in terms of a turnaround in Europe? Are you at all optimistic that they can kind of break through and begin to grow?
What Europe needs is regulatory reform and fiscal action. The problem is the governments don't have enough money and resources to cut taxes with their social promises. They're not quite as strong in a strong position to do that. Look, if lower rates were the answer, Europe would be leading the economic engine of the world right now. And it's also hurting their banks. It's having a double effect. The layoffs, the tens of thousands of layoffs in the European financial sector is real. Their inability to take risk, to encourage growth. What Europe needs is a growth-driven strategy. And in fact, here at home, I think if the Fed does lower later in October, we're going to see a very muted response. It's not like some business owner's going to say, great, rates are a quarter point lower, I'm going to go build that factory. That's not going to happen. The benefit to lower rates right now, it's as pushing on a string. We've seen most of the benefit of lower rates, and now we need to see economic growth, policy certainty, business investment to take us to the next level.
So, Mark, can I follow up on that? The one area where lower rates might have an impact, and one area that has not participated in this growth period that we've been in, is housing. And I sort of hold out hope that in 2020, that's going to be a sector that actually finally begins to participate. Do you think that's off the mark, or do you think that could happen?
Well, lower rates impacts housing. It has impacted housing positively in one regard. Refinances, putting money in people's pockets is always a good thing. It's been one of the subtle boosts with the strong economy story. In terms of housing and investments, there's two factors. First, people remember 2008 market crashes. People no longer look at houses as a piggy bank and a guaranteed way to increase wealth. The second is buying habits have changed. Millennials are no longer as interested in the big move-up home. They're very content renting, urban living. There's been a real shift in purchasing tendencies among consumers, and I think that's one of the drivers that's slowing down the housing market.